Welcome everyone, welcome to Module 2 of our course. We are going to look at Guide to Understanding Currency Pairs in this module. The main things we're going to look at in this module is the 8 main currencies that are traded in the Forex market, how currencies are quoted in the Forex market, how to read the currency codes, and the differences in the currency pairs such as the major trading pairs, minor pairs, and the exotic pairs. Okay, we're going to look at the main currencies that are traded in the Forex market. They make up for more than 90% of the Forex trades in everyday volume. Okay, let's take a look at them one by one. These are not in any particular order. I just listed them there. We have the US dollar. We have the euro, Japanese yen, British pound, Australian dollar, New Zealand dollar, Swiss franc, and the Canadian dollar. These currencies together make up about 28 different currency pairs. We are mainly going to be looking at these different cross pairs for the purpose of this course. Okay, let's move on to the next section where we're going to take a look at the type of pairs such as the major pairs, minor pairs, and the exotic pairs. Okay, let's take a look at currency pair type. We're going to take a look at major pairs here. Don't confuse them with the main currencies we looked at earlier. What are major pairs? Major pairs are any main currency mix with the US dollar. So the main currencies are what we looked at, the 8 currencies before. Them mixed with the US dollar makes up the major pairs. Here are your major pairs. For example, Euro US, US Canada, British Pound US, US Japanese Yen, Australia US, US Swiss franc, and finally New Zealand US. Okay, let's move on to minor pairs next. Okay, let's take a look at minor pairs. Minor pairs are any currency pairs without the US dollar involved in it. We're just looking at the main pairs out of the 28 pairs we looked at earlier. So out of them, if we have any pairs without the US dollar mix in it, those are called minor pairs. Let's take a look at some of the examples here. We have the Euro, British Pound, Australia, New Zealand, Japanese yen, Australian dollar, and many more. Out of the 28, you could have any one of them. As long as the US dollar is not mixed in it, it's called a minor pair instead of a major pair. And now we are looking at exotic pairs. What are exotic pairs? Exotic pairs are all other currency pairs that are outside of the 28 pairs that we looked at earlier. So our main currencies make up 28 pairs. So anything outside of the main currencies that makes up a pair would be considered an exotic pair. For example, we have the US Singapore dollar, US Indian rupee, Euro Mexican, or any other currency pairs that is outside of the 28 pairs we looked at are considered exotic pairs. Exotic pairs are rarely traded by individuals. Mainly institutions would trade exotic pairs. Okay, we're going to move on to how to read the currency pairs and how they are quoted. Okay, let's take a look at how to read the currency codes. Now we looked at currency pairs. Let's take a look at an actual code here. So we have the US Canada pair here, and it is quoted at 132. So what does that mean to us? So in the front we have the US dollar here. So the US dollar would be considered the base currency. So second we have the Canadian dollar. The Canadian dollar would be considered the quote currency. Then at the end we have the price. So price is how many units of the quote currency is required to buy 1 unit of the base currency. So in this case, we need $1.32 Canadian to buy $1 US. So US is the base currency and the Canadian is the quote currency and the price is in Canadian. So in order to buy $1 US, you have to pay $1.32 Canadian. Okay, let's take a look at one of our examples here for a vacation to Florida. So after a long, hard winter here in Canada, Nora decided to take a vacation to Florida and enjoy the beaches there. So she decided to exchange 3,000 Canadian into US dollars. She got a rate of 1.2 when she was doing the exchanges. So for every 1,200 Canadian, she got 1,000 US dollars. So when she came back to Canada, she had about 1,000 US unspent. She cannot spend that money here in Canada because she had to exchange it back to Canadian dollars. So at that time, when she came back, the rate has gone up to 1.3. What does that mean for Nora? So she sold her 1,000 US and received 1,300. So originally she paid 1,200 for 1,000 US. Now she is receiving 1,300 because the rate has gone up to 1.3 now. So in the process, Nora has made about $100 in profit. Now this is impossible in real life in a 4-day or week vacation to Florida, but I'm just using it as an example. Okay, we are at the end of module 2.0. Next, we will be taking a look at what is PIP,